Most people think they know what printing money looks like. A government runs out of cash, turns on the money printer, and suddenly the economy is flooded with brand new bills. It sounds reckless, almost cartoonish. But the strange truth is this: in most modern economies, almost no one is actually printing money. No trucks full of cash, no giant machines running day and night. Yet trillions of dollars can appear in the system in a matter of weeks. And when it happens, it quietly reshapes everything, from the price of groceries to the strength of entire countries. So what really happens when a country prints money? Because the answer is both more boring and far more powerful than most people realize. And right now, it matters more than ever. Let's start with the myth. The popular story goes like this: a government needs money. Maybe it's fighting a war. Maybe the economy is collapsing. Maybe politicians promised things they can't afford. So they simply create new money. Historically, this did happen. In places like Weimar Germany in the 1920s, the government literally printed mountains of banknotes. Prices exploded. A loaf of bread could cost billions of marks. People carried cash in wheelbarrows. Zimbabwe did something similar in the 2000s. The country issued a $100 trillion note bank. But modern economies rarely work that way. Today, when people say printing money, they're usually talking about something far more subtle: a financial maneuver involving central banks, government debt, and digital money. No printing presses required. To understand it, we need to meet two key players. First, the government. Governments spend money on everything: roads, healthcare, defense, pensions, infrastructure. But governments almost never pay for all of this with taxes. Instead, they borrow. And they borrow by issuing something called government bonds. A bond is basically an IOU. The government says, lend us money today, and we promise to pay you back later with interest. Investors love government bonds because they're usually considered safe. Pension funds buy them, banks buy them, insurance companies buy them. But sometimes investors don't want to buy enough, or if the government wants to borrow far more than the market can comfortably absorb. And this is where the second player enters the story: the central bank. In the United States, it's the Federal Reserve. In Europe, the European Central Bank. In the UK, the Bank of England. Central banks have a very unusual power. They can create money digitally, not by printing it, but by typing numbers into existence. Here's how the process actually works. Imagine the government wants to spend $1 trillion more than it collects in taxes, so it issues $1 trillion worth of bonds. Normally, investors buy these bonds. But if demand isn't strong enough, or if the economy is fragile, the central bank can step in. And it does something very strange. It buys the bonds itself. But it doesn't use existing money. Instead, it creates new reserves inside the banking system. With a few keystrokes, the central bank credits commercial banks with brand new digital money. Those banks then hand over the bonds. The central bank now owns the government's debt, and the government now has the money to spend. Just like that, new money has entered the system. No printing press, just balance sheets expanding quietly in the background. This process became famous after the 2008 financial crisis. The global economy was collapsing, banks were failing, credit markets froze. Central banks panicked. So they launched massive programs called quantitative easing, QE for short. The name sounds technical, almost harmless, but the scale was staggering. Between 2008 and 2014, the Federal Reserve created over $3.5 trillion to buy government bonds and mortgage securities. Europe and Japan followed. Then came 2020. When the pandemic hit, economies shut down almost overnight. Governments needed enormous amounts of money to keep people employed and businesses alive, so central banks went even bigger. In just a few months, trillions more were created. On paper, it looked like money printing,
But what was actually happening was a coordinated dance between governments issuing debt and central banks buying it. Now here's where things get interesting, because creating money like this doesn't immediately cause chaos. In fact, at first it can feel almost magical. Governments get funding, markets stabilize, borrowing costs stay low, stocks often rise. For a while, everything looks fine. This is why many economists argue that money creation is simply a tool. Used carefully, it can support the economy during crises. But the hidden mechanism, the uncomfortable math, shows up later. Because money is not just pieces of paper, it represents purchasing power. If the amount of money in the system grows much faster than the amount of goods and services, something has to adjust. Prices. More money chasing the same stuff. That's inflation. And inflation doesn't show up evenly. It sneaks in through different doors. First, financial assets. Stocks rise, real estate rises, art, collectibles, even cryptocurrencies surge. Why? Because the new money often enters the system through banks and financial markets first. Asset prices inflate before everyday prices do. Then, eventually, it reaches the real economy. Housing gets more expensive, food gets more expensive, energy gets more expensive. Suddenly, the same paycheck buys less. This is where the irony appears. When governments create money, they're technically not taxing anyone directly, but inflation can act like a hidden tax. It slowly erodes the value of savings. If your bank account earns 1% interest, but inflation is 5%, your money is quietly shrinking. Meanwhile, debt becomes easier to repay, and that's convenient because governments are often the largest debtors of all. Now, zoom out. There's a reason powerful economies can do this more easily than smaller ones. Trust. When the United States creates dollars, the world still wants them. The dollar is used in global trade. Oil is priced in dollars. Central banks hold dollars as reserves. That global demand gives the U.S. enormous flexibility. Other countries don't have that luxury. If a smaller economy creates too much money, investors can flee, currencies collapse, imports become expensive overnight, inflation can spiral much faster. That's why printing money can stabilize one country while destroying another. But even for large economies, there are limits, because once inflation becomes visible, central banks face a brutal choice: keep creating money and risk runaway prices, or slam on the brakes, raising interest rates, reducing the money supply, slowing the economy. This is exactly what many central banks have been forced to do recently. After years of massive money creation, inflation surged across the world. Suddenly, the same institutions that flooded the system with liquidity are trying to pull it back out, and that process is painful. Higher mortgage rates, expensive business loans, stock market volatility, the hangover after the party. Which brings us to the uncomfortable question: if creating money can temporarily stabilize economies, boost markets, and help governments fund enormous spending, why wouldn't countries keep doing it forever? Why not simply finance everything this way? The answer lies in something fragile. Not gold, not mathematics, belief. Money only works because people trust that it will hold value tomorrow. Once that belief cracks, even slightly, the entire system starts behaving differently. Prices adjust faster, investors demand higher interest rates, currencies weaken, and restoring trust becomes extremely expensive. So, the next time you hear that a country is printing money, remember what's actually happening. It isn't stacks of banknotes rolling off a press. It's a quiet transaction between governments and central banks. Numbers appearing inside digital ledgers, debt transforming into money. A powerful tool that can stabilize economies in emergencies, but also one that quietly shifts wealth, distorts markets, and tests the limits of trust. And the real question isn't whether countries can create money. We know they can. The real question is how much the system can absorb before people start asking whether that money still means the same thing it used to.